You know what's interesting? Right now, everyone is asking the same question. Is this the bottom or is something worse coming? Because on one side, you are hearing rates might drop, opportunities are coming. And on the other side, you are hearing recession, oil shock, inflation is rising again. So, which one is it? Because if you are a buyer, seller, or investor in 2026, this is not a small decision anymore. This is timing your next 5 to 10 years of wealth. And that's exactly why I want to break this down today. Not based on headlines, but based on what one of Canada's top economists, Benjamin Tal, is actually saying. Let's start with the reality no one is simplifying properly. We are currently in what he calls an oil shock. Now, historically, that sounds scary, right? Because every time we have had oil shocks, 1973, 1982, 1991, 2008, they were followed by recessions. So naturally, the fear is, are we heading into another one? But here is where it gets interesting. Benjamin Tal makes a very important distinction. Oil shocks do not cause recessions. It's the response to oil shocks that causes them. Let me explain. When the oil prices go up, inflation goes up. Central banks panic. They raise interest rates aggressively. And that's what slows market down. That's what slows the economy down. And that's what creates the recession. So the real question right now is not, are we in an oil shock? Because we are. The real question is, how will the Bank of Canada respond? And this is where things shift. Because if you have been waiting for interest rates to drop, you need to hear this. Benjamin Tal believes the Bank of Canada will likely do nothing. Not cut, not raise, just hold. Possibly all the way into 2027. Now think about what that means. Because for the last 2 years, most buyers have been sitting on the sidelines waiting for just one thing. When rates will drop, I'll enter. But what if rates don't drop? What if they just stay? Now, let's layer in what's actually happening in the market. Because this is where most people get it wrong. Right now, the housing market is already in a recession phase. Condo markets, especially small units, are declining significantly. Investors are stepping back. Inventory is sitting. So on the surface, it feels like maybe prices will keep falling. But here is the part nobody is connecting. We are not building enough homes right now. In fact, Benjamin Tal said something very powerful. Homes are still too expensive to buy, but not expensive enough to build. Let that sink in. Builders are not building. Projects are being delayed. And what you are seeing in housing starts right now is actually data from 12 to 18 months ago, not today. So what happens next? Let me walk you through the sequence. Prices soften, buyers hesitate, builders stop building. Supply dries up, and then suddenly prices don't just stabilize, they snap back. And this is where 2026 becomes very important. Because Benjamin Tal calls 2026 a transition year. Not the peak, not the crash, not the boom. A transition between a weak, uncertain market and a more stable, healthier market in 2027. Now let's talk about something that's quietly building pressure behind the scenes. And this is critical. The mortgage renewal wave. In 2026, a large number of homeowners who bought in 2021 are renewing at much higher rates. And about 5% of them will see payments increase by over 40%. That's not small, but here is the twist. Banks are already stepping in. They are extending amortizations, they are restructuring payments. So instead of a crash, what we are getting is a slow pressure release. Now let's zoom out even further, because real estate doesn't move in isolation. We have rising food prices, energy volatility, slowing job markets, global geopolitical tension. But at the same time, we also have AI investment exploding, government incentives coming in, HST rebates on new builds, development charges being reduced. So what does all of this actually mean for you? Let's break it down depending on where you are. If you're a buyer, this is where it gets strategic. You are currently in a market where prices are softer, competition is lower, negotiation power is higher. But you are also in a market where supply is quietly shrinking. So the window you are in right now, it's not permanent. The biggest mistake I am seeing right now is waiting for the perfect moment. Because by the time everything feels safe again, the opportunity is already gone. If you're a seller, you need to shift your mindset. This is not 2021, but it also not a crash. It's a repositioning market. And the biggest mistake sellers are making right now is pricing based on past expectations instead of current strategy. Because in this market, the right pricing is equal to activity. The wrong pricing is equal to stagnation. If you're an investor, it becomes very interesting because condo markets are correcting. Micro units are declining further. Investors are stepping back, which means entry opportunities are forming, but only if the deal works today, not based on future appreciation, lower rates, higher rents. Now, let me ask you something. In 2026, if it is a transition year and 2027 is expected to stabilize, then what does that make right now? It makes this, the positioning phase. The phase where smart buyers enter, strategic sellers adjust, investors pick carefully before momentum returns. And this is exactly why I keep asking my clients, what would you do if the market doesn't wait for you? Because that's the real risk right now, not the crash, not the recession headlines, but missing the moment where conditions are still in your favor. Now, I want to hear from you. Are you waiting right now in the sidelines, or are you actively planning your next move? Because in this market, it's not about reacting anymore. It's about positioning. And if you want me to break down your situation specifically based on your numbers, your timeline, your strategy, just comment plan or reach out to me directly.